Okay, let's dive into this. In today's markets, the words investing and speculating are thrown around so much they practically mean the same thing to a lot of people. But here's the truth, they're not even in the same league. And honestly, understanding the difference might be the most important financial lesson you ever learn.
So let's just ask it point blank. When you put your money to work, are you actually investing, or are you just placing a really sophisticated bet? That line has gotten so blurry, and not knowing which side you're on is one of the quickest ways to lose your shirt. So in this explainer, we're going to draw the map for you, and then we're going to hand to the compass to navigate it.
All right, first things first. Before we can even start to map out different assets, we need to establish a North Star. We have to understand the bedrock principles of what a true investment really is.
And look, there is no better place to start than with the godfather of value investing himself, Benjamin Graham. His definition here is crystal clear. It's not a suggestion, it's a hard and fast rule that has stood the test of time for decades. If an activity doesn't tick all three of his boxes, Graham says it's not investing. Period. It's something else.
So let's unpack that, because these are the three non-negotiables. First, thorough analysis. That means you've actually done the homework. You've looked at the numbers, not just the news hype. Second, safety of principle. And this one is huge. An investor's first question isn't how much can I make, it's how do I make sure I don't permanently lose this money? And third, satisfactory return. This means the profit you're expecting comes from the asset itself, from its earnings, its dividends, its internal value.
The legendary founder of Vanguard, John Bogle, gave us another fantastic way to think about this. He basically said your total return comes from two different buckets. You've got investment return, that's the real stuff, what the business actually produces. Then you have speculative return. That's just the mood of the market, how people feel about the business. Investors focus on what the business earns. Speculators are betting on what the crowd feels.
Okay, so with those definitions locked in, let's be super clear. This is not a binary choice. It's not investing on one side and speculating on the other. It's a huge, wide spectrum. So now, let's actually start mapping out that territory.
And here you can really see the two archetypes side by side. Think of the investor as a patient farmer. They're carefully cultivating a business for its cash flow, its harvest, over many years. Their main goal is just to avoid a total crop failure. The speculator? They're the hunter, looking for a quick score, a rapid price move. They're willing to take on huge risks for that one big payoff. It's a totally different game, with totally different rules.
So keeping those two mindsets, the patient farmer and the quick hunter, in our heads, let's go on a tour. We're going to travel across the entire map of capital and see where different assets fall, from the farmer's safest field all the way out to the hunter's wildest frontier. Our first stop is the absolute bedrock of the entire investment world, U.S. Treasury bonds. When you buy one of these, you are literally loaning money to the U.S. government. The chance of you not getting paid back is considered pretty much zero. This is as pure an investment as it gets. Your main risk isn't default, it's just that inflation might eat into your returns.
Now let's take one step out from that safe harbor. Here we find blue chip stocks. You know them. The massive, stable, household name companies that have been making money for decades and consistently share their profits through dividends. The reason to own them is built on that steady stream of earnings. We are still well within the investment side of our map here.
Okay, now things start to get a little spicier. We're entering the hybrid zone with what are called high-yield bonds, or more bluntly, junk bonds. These are loans you make to less stable companies, and in return, they promise to pay you a much higher interest rate to compensate you for a very real risk that the company could go bust and you could lose everything. It's got a foot in both worlds. You get income like an investor, but you're also speculating on the company's survival. Next up, growth investing. This is buying into companies that you hope will grow at lightning speed. We're definitely moving further to the right on our spectrum here, because so much of it depends on predicting a future that hasn't happened yet. Now, if you do it with a strict focus on valuation, on what the company is actually worth today, it can still be investing. But the second you ignore the price and just bet on the story, you've just pole vaulted over the line into pure speculation.
And here we are at the far, far edge of the stock market. Welcome to the casino. Penny stocks are these tiny, usually unprofitable companies that aren't traded based on business fundamentals. Nope, their prices are moved almost entirely by hype, rumors, and social media momentum. The chance of a total loss here is massive. This is speculation, plain and simple.
So let's venture off the traditional map entirely and head to the digital frontier. Cryptocurrencies. They pose a really interesting modern challenge to Graham's classic definition. Why? Well, because they don't generate any cash flow.
There are no earnings reports, no dividends, no profits to share. Their value is driven entirely by what the next person believes they're worth.
And if we just circle back to Graham's #1 rule, safety of principal, it becomes really hard to classify something as an investment when it has the potential to lose 80% of its value, or even more, in a very short time. That kind of wild volatility is the classic signature of a high-risk speculative asset.
And just when you think you've reached the edge of the map, there's another frontier. NFTs, collectibles. This is what we'd call extreme speculation. This is a market that often runs on something called the greater fool theory. That's the idea that the only way you make money is by finding someone, a greater fool, who's willing to pay an even higher price than you did for the exact same thing.
So, wow, we have toured the entire map, from the safest of safe harbors to the absolute wildest frontiers of finance. Now, let's bring this all back home. It's time to give you a personal compass that you can use to navigate your own decisions.
This scorecard right here is a fantastic practical tool. Seriously, you can use it to score any asset you're thinking about buying, for sure. But here's the more important part. Use it to score your own behavior. Where are you getting your info? From a company's financial statements or from Twitter? What's your emotional state? Is it calm patience or is it anxiety and FOMO? Be really honest with yourself. Your score will tell you exactly where you're standing.
Now, does all of this mean you can never, ever speculate? That you can't have a little fun? Of course not. But you have to be smart and responsible about it. And a really simple, powerful way to do that is with something called the core satellite approach.
And the idea is just so simple and elegant. The huge majority of your money, let's say 90%, goes into your core. This is for your serious, long-term wealth compounding goals, your boring, proven investments. Then, that small remaining slice, your satellite, that's your permission slip to play. It's the money you can afford to lose on those higher-risk ideas without blowing up your entire financial future. But there are rules, and this is the crucial part. Your core is for financial survival. Your satellite is for taking flyers. And the most important rule of all, the one you cannot break, is that this is a one-way street. You never ever raid your safe core investments to pour more money into a losing bet in your satellite. If that satellite goes to zero, it stings, but your life plan doesn't change one bit. And that brings us right back where we started, with the simple wisdom of Benjamin Graham. Look, speculating isn't automatically bad or evil, but deluding yourself, confusing it with investing, is a catastrophic mistake. Know the difference. Know which game you're playing at all times, and I promise you, you will be miles and miles ahead of the crowd. That self-awareness, that's your real key to financial survival.